This week on our free preview, join us as we take a look at the Fed rate cuts that are on the table. Will they come here in March or wait until June, or will they come at all? But for now, sit back, relax, and join us as we take you through the numbers. Hi, Lynn.
Hi, Lyndsay.
How are you?
I'm great. How about you?
I'm good, thank you. Thank you for being here to pre-record this episode.
Yes, we're a little bit early.
Yes, we have a big, busy week next week with our summit. This topic, though, I feel like we were talking about it, if not weekly, monthly.
Yes.
And we haven't really touched on rate cuts in some time.
Yes.
It's almost like there's been some other big economic headlines that we've had to cover. I don't know what those might be.
Oh, what could that possibly be?
Yeah, so kind of circling back to, what we've been focusing on
with
the rate cuts in the Fed. So this first headline, cooler inflation paves the way for Fed to resume rate cuts in June. So this article is actually skipping over the next meeting and looking towards June. Consumer inflation is cooler than, or what was cooler than expected in February. Tariffs could rekindle price pressures and slow the economy. The Fed is to keep price rates unchanged next week, according to the article, and pace of rate cuts will depend on the impact of Trump's policies. So that's kind of the Cliff Notes version of this article. But cooler than expected February. Let's start there.
Yeah. So again, anytime we get cooler than expected, the first question is, well, who expected it?
Yeah.
And so I know that's coming next from you. I don't mean to steal your thunder here, but really, as we're talking about both the CPI number that was quoted in this article, and also we then on Thursday got the PPI, the producer price inflation data, and that also came in a little bit lower than expected. That was essentially flat, and they had been expecting the median market expectation, consensus expectation was about 0.3% rise. So there is this kind of, we thought inflation would be a little bit stickier, a little bit higher, and it was surprising to the downside. So the market certainly can take this as good news because, again, we had this path of interest rates. We had this expectation for inflation. If inflation comes in lower, does that give the Fed more ability to cut? Well, yes, on the surface it does. But like we always say, 1 month of data does not make a trend.
Very true.
And as I look at this February data point, it's coming in the wake of January and December that had been a little higher, had been a little stickier. So this is not enough to totally change the course, even, if we did kind of continue on this trajectory. I hate to say it this way, but this is what ITR had been expecting. A little bit of noise as we get to that low point. But for CPI especially, we think the low point comes probably somewhere let's call it first half to mid-year. I don't think we're going to quite get that 2% low, but we'll be close to it. We're moving in that direction.
And that 2% low is what the Fed is historically looking for to get inflation as close to that 2% as possible.
2% is their target. So 2% is not saying once we hit 2%, then we can do whatever else, right? You just kind of use that as our check the box and move on. They want to keep inflation at 2%. I think that's going to be very hard because as we've been saying, especially as the inflation data comes in stickier, inflation is still showing signs of ticking up, right? The fundamental factors, even before we put tariffs onto the equation, it is for rising inflation by the back half of this year. So I think we'll graze that 2% level, but that is not where we're staying. We're not in equilibrium. We're probably seeing that as kind of a touch and then launch again into higher inflation.
And if I'm a business, what can I be preparing myself to do for that low point? What types of business decisions can I be making? Is that a good time to take out money if I need to do some capital investment?
I think that's a great time because, again, that low point, if you're talking about touching the low, that's about as good as interest rates are going to get. I don't think they get materially looser again, absent some rate cut that isn't really expected for that March meeting. But the types of loans that these businesses are engaging in, those are not predicated on the federal funds rate. Those are usually market-driven, supply-demand balance. And so that's where we see these inflation inflation expectation, the kind of long-term borrowing cost, it's not moving in lockstep. It's not a one-to-one relationship to Fed policy.
Right.
So I think this is about as good as we can expect. Now, beyond that, if you are looking for kind of your margins in this inflationary environment, that is going to be critically important. What are my labor costs? What are my material costs? Maybe I can do some pre-buying. If inflation's picking back up in the second half of this year, do I have the ability to store inventory if it's not too costly to do so?
Right.
I think this is the time to kind of seize on that buying opportunity.
Right. There was a quote that I pulled out of this article in that vein. We continue to think that underlying inflation is on a bumpy downward trajectory, ex tariffs that would allow the Fed to deliver a good news inflation cut in June if the Trump administration moderates on tariffs and tariff uncertainty, and a bad news cut if the labor market weakens materially, regardless of tariffs, provided that inflation expectations remain well anchored.
Yes.
And Fed Chair Jerome Powell has said that he wants to wait and see the economic effects of the entire suite of Trump policies, which also includes tax and spending cuts, deregulation, and tighter immigration. So he is outwardly saying that all eyes are on those potential policies, and is that because, and I think you've said this before, and I think this is why you are doing a keynote at the summit, Policy, Not Politics.
Right.
The majority of those policies at play, the results are largely inflationary.
More are inflationary than are not, and or especially that are disinflationary, deflationary. But yes, and so we see actually very similar wording from Jerome Powell. He always talks about being data dependent. We're going to wait and see. We're not telling you anything that we're going to do. He really gets cagey when he's asked what will the path be. And this is another example. He can't come out and say, because tariffs, we will do this. He doesn't want to guide the market in that way and issue guarantees.
Right.
Because then you're committed to them. And if it doesn't happen right in 2018, we didn't see the full pricing impact of tariffs quite as soon for a number of reasons, right? Importers absorbed for a while, they absorbed price changes, but also there was so much front running of tariffs that inventory cycle, it gave time to let the kind of slow impact of higher inflation come through.
Yeah.
So we've seen this play out once in a way that didn't exactly match up to expected. If Powell had said we're doing X because the inflationary impact will be such, and then the inflationary impact wasn't such, do you still do that? Do you shock the market? Really, the Fed doesn't want to shock the market.
No, definitely not. That's all the time we have for today here on our free preview. Click on the link in the description below to sign up for full-length episodes through our Insider Plus membership. You'll have access to not only this episode, but past and future episodes as well. But for now, bye, Lauren.
Bye, Lyndsay.